In this video, we're going to go through some of the biggest HSA mistakes that I see way too many people making. Now, at the time of filming this video, my other health savings account videos have almost 1 million views with thousands and thousands of comments, so I have a pretty good idea of the mistakes that you need to look out for based on all of that data. I'm also going to share some HSA data with you so that you can compare yourself to your peers. This is going to be things like the average HSA balance by age, annual contributions by age, annual distribution by age, and a few other things. If you haven't watched the HSA video that I released last week, then you might want to start there so you're up to speed on what we're talking about here. Then come back to finish watching this one. The biggest and most costly mistake that I see a lot of people make with an HSA is not keeping a record of their medical receipts. This is important because you want a clear record that the money you're withdrawing from the account is for medical expenses that are HSA approved. For example, if you just paid $500 for a pair of glasses, then you'll use that bill to show proof of that medical expense so that you can withdraw $500 from your health savings account. Think of these receipts like they're dollar bills because they basically are. They're essentially Willy Wonka's golden ticket that you need to claim your prize. There are 2 ways to use money from your HSA for medical expenses. Number 1, you can either use the debit card issued by your HSA provider like the one you see on screen from Lively, or you can withdraw funds from your health savings account to reimburse yourself if you paid out of pocket for any approved medical expenses. Either way, you're going to want to have a record of the physical copy of the bill or receipt that states what the money was spent on. I'll show you my foolproof receipt tracking process in just a minute, so hang tight. I've told this story before, but it's worth repeating so you understand how this can come back to bite you in the butt. I worked with a guy who went to Walgreens and used his HSA debit card on some prescription meds. Now, he figured it wouldn't be a big deal if he also threw in a couple candy bars as well. While candy bars could contribute to type 2 diabetes, they aren't an approved medical expense. So he was caught and had to pay a penalty for using some of his HSA money on non-qualified medical expenses. The IRS and HSA providers don't mess around with the rules about only using the money for qualified medical expenses. So I would highly recommend not trying to get one over on them and assume that they're just gonna catch you. Keeping track of receipts over the years is even more important for the people investing some or all of their HSA money because they're paying for things out of pocket today than cashing the money in later down the line so that they can keep money invested for a longer period of time. For my HSA investors out there, if you go to cash in a medical receipt in 20 plus years for an expense that you paid for today, then odds are you're going to lose that receipt between now and then, so we need to find a good solution to track these things. Before I show you my receipt tracking process, please help support the adventures of Little Miss Molly as well as this channel by hitting that thumbs up button, subscribe button, and tapping that notification bell. Here's my HSA receipt tracking process. Now, if you find it helpful, then feel free to implement it for yourself. If not, then find a better way that works well for you. Real quick, I need to hop in here during the editing process to say that you do not want to rely on your HSA provider to track all of your medical receipts for you. I've seen a lot of people say this online, how it's a great benefit that they do this for you. I completely disagree. The reason for that is if at some point in the future you become disgruntled with them, they piss you off, and you're like, I'm gonna get the heck out of here. Well, they have copies of all of your medical receipts, so guess what? You're stuck with them, and you gotta deal with that whole process of getting copies, if they'll even give them to you, who knows? And you need these medical receipts to have a record of these expenses that you had in the past so you can cash the money out. That's why I think it's very important to track all of these receipts and keep all of those records on your own outside of the HSA provider. That way you are not beholden to them forever. You're going to need 3 different things. Number 1, a phone camera or some way to capture a picture of your receipt or bill in person or online. Number 2, some sort of free online storage like Google Drive. And number 3, spreadsheet software like Excel or Google Sheets. Every time you have a medical expense, you'll take a quick picture, then upload it to the cloud storage location of your choice. Now make sure the important info is legible. That means date, name of business, the name of the expense, and the amount that you spent. I personally have two different folders in my Google Drive to help me organize everything. The first one is called To Be Paid Out, and the other is called Paid Out. For the expenses where I haven't cashed them in yet, I'll put the picture of those receipts in the To Be Paid Out folder. When I eventually cash out that receipt amount, I will move it to the Paid Out folder. That way, I always have a paper trail in case the IRS wants to audit me a couple of years after I officially take ownership of that medical expense. To help keep track of the hundreds of receipts I'll eventually cash in on, I need to name it in a way that's going to be easiest to filter through in 20 plus years when I start withdrawing money. The way I do that is by naming each file by the dollar amount and the date of when I had the expense. The reason I start with the dollar amount is because in 20 years, I'm going to be cashing out HSA money based on a lump sum amount. It's going to be easiest for me at that time to find all of the receipts that add up to the amount that I'm trying to withdraw. For example, in 25 years, if I want to withdraw, say, $1,000 from my HSA, I'll go find multiple receipts that add up to $1,000. Then consider those receipts as how I am accounting for that money. I'll then move the receipt copies to the Paid Out folder and be done with it. There is one more step just to make everything easier for future me in 20 plus years. Now, I also account for each expense in a spreadsheet that I created for myself, which is of course called HSA Spreadsheet Tracker. That way I can cross-reference the copy of a receipt that has the amount and date on it to a line item in the spreadsheet. Right before or right after a copy of the receipt is uploaded to my Google Drive, I'll add the same info into this spreadsheet right here. As you can see, I have the date, type of service, the cost, company I paid for the service, confirmation that I uploaded the receipt, and whether or not I've paid myself out for that particular receipt. This spreadsheet is also a nice way to see a running grand total of how much I'm able to withdraw from my HSA, even though I don't plan on touching it for a very long time. I need to call something out specifically to make it crystal clear because I get a ton of questions about this. There is no expiration date for when you have to use your receipts by. The receipt that you have from the pair of glasses, doctor's office visit, or prescription that you pay for today can be used to withdraw money from your HSA in 20, 30, 40, or however many years into the future. Another common question I see is around when you incur a medical expense and when you can withdraw that money from your HSA. You can only use your HSA money on medical expenses that you incur after you open your first account. So if you get your first HSA and start contributing in the year 2023, then you can only withdraw money from the account for medical expenses that you have after that point in time. You cannot withdraw money for medical expenses in the year, say, 2022 or any time prior to that. Something else along the lines of this point, if you only contribute to an HSA for, say, 5 years, then switch away from a high deductible health plan, you can still use the money within the account for approved medical expenses even after you've left an HDHP. A ton of people think that if they invest their HSA money and it grows to a couple $100,000, that there's no way they're ever going to spend that much on medical expenses. I'd hope most people understand this, but I'm going to mention it anyways. We're not invincible. When it comes down to it, as we get older, we usually spend more money on medical expenses. According to Fidelity Retiree Healthcare Cost Estimate, an average retired couple age 65 in 2022 may need approximately $315,000 saved to cover healthcare expenses in retirement. I honestly hope that every single one of you watching this lives an extremely happy and healthy life. And if you happen to use less on medical expenses than what is in your HSA, then you should be jumping for freaking joy. But it's better to be prepared by having a large HSA balance and not needing it than it is having a ton of medical expenses with barely any money in your HSA because you didn't contribute to it since you thought that there was no way you were ever going to spend that much on medical. As I've mentioned before, starting at the age of 65, you can withdraw HSA money for non-medical expenses without paying the penalty. Now, you'll still have to pay taxes, so the account essentially turns into a traditional 401k or traditional IRA, so technically, your money isn't locked into only being used for medical-related things. A big warning to all my health savings account people. The Employee Benefit Research Institute found that when an employer contributes money for you as a bonus, the average individual lowers their contribution amount. A study from 2019 found that when an employer didn't contribute a bonus amount to their employees' HSA, the individual contributed $2,500. When the employer did contribute a bonus amount, in this example $900 worth, the individual only contributed $1,900 that year. From a behavioral finance perspective, this makes complete sense, because if they're going to contribute $900 for you, then their $900 plus your $1,900 contribution brings you to a total of $2,800 of contributions for that year. But if you would have continued contributing $2,500, then your total contribution for that year would be $3,400. I'm going to put my Uncle Jarrad hat on for a second. I want to encourage you to not lower the amount that you were already going to put into your HSA. Do not let the amount that your employer contributes for you determine how much you are going to put in there. If you cannot afford it, then I completely understand. But if you can afford it, even if it feels just a little bit uncomfortable, remind yourself that more is always better. Along the same lines as employer contributions, EBRI also found that higher HSA contributions were associated with lower 401k contributions. Once again, I understand that a lot of people only have so much money to go into investing, so don't take this the wrong way. But I wanted to point out this trend that they found so that you can hopefully get ahead of it and not allow it to negatively impact how much you are contributing to your 401k. A lot of people get worried about having to be on a high deductible health plan so that they can contribute to an HSA. But the good news with health insurance is that we all have the ability to switch it up every single year. So if you get through this HDHP year and realize that it's just not for you or your current situation, then it's pretty easy to switch back to the type of plan that you used in the past. If it's your first year on an HDHP, then just consider this a test year. What I personally did to help ease my worries was to make sure that I was doing everything in my power to keep up on my overall health, whether it was making sure my nutritional health was on point, my physical health, my sleep, as well as my mental health. Now, all of those things were a top priority to keep myself out of the medical system to reduce my ongoing expenses in this area. If anything, you should use being on an HDHP as motivation to make those healthy lifestyle changes so that you can reduce your overall health costs going forward. Before I get to how your age group is handling their HSA, I want to share a good tip that I've received from a ton of viewers that comment on my HSA videos. A few of them are leaving enough cash in their accounts to cover their deductible in case anything happens, then investing all of the money beyond that amount. I love this idea because it makes you feel safe enough to invest the money because you already have your maximum payout amount set aside just in case anything happens. I know it's always nice to get an idea of what your peers are doing, so I'm going to quickly run through some HSA stats so that you can see how you compare to people in your age group. 11.4 million health savings accounts were used to gather this information. Now at this point, they only have the data updated through 2020, but I can't imagine the numbers have changed by too much between then and now. When it comes to end of year balances, you can see that the older someone is, the more they have in their account, which makes sense. If you notice these amounts, it would only take 1 or even 2 years worth of contributions to put anyone watching this way above the average of their age group. So that could be a goal that you're shooting for if you want some motivation. For annual contributions by age, it slowly increases, then drops off when people 65 and older are most likely in the retirement stage of life where they're not contributing any longer. Remember that starting in 2023, the maximum an individual can contribute is $3,850. So find your age group on this graph and try to contribute more than your peers if possible. The average distribution by age group in 2020 increased as people got older, then it dropped off for the 65 and older crowd, which is pretty interesting. I'd be curious to hear your thoughts, so leave a comment down below with your guess as to why you think they withdrew a lot less money than the two age groups before them. Presence of investments other than cash is the next one. Now, I'm surprised that there are only 2 age groups where 9.4% of accounts are investing. I wonder if people even know that this is an option, or maybe they're just using it as a spending account for medical expenses in the near term. No matter where you fall on these charts compared to your peers, the only way you're going to get ahead and stay ahead is by understanding the most important number in personal finance, which I talk about in this video to your left. Make sure to hit that subscribe and thumbs up button, and check out the description of this video for additional resources to help you with financial independence, investing, and ways to help support this channel, and of course my dog Molly. I'll see you in the next one, friends. Done.